In 2025, the Canadian stock market had its best year since 2009. It surged over 28%. Yet for the average Canadian, real income actually was stagnant. It even fell for 8 consecutive quarters. If your investments are doing well, if you see your TFSA and RRSP booming, but your life is still feeling expensive, this video is exactly for you. How is it possible for the market to be at an all-time high while the people are still in a somewhat recession? How does this disconnect affect your retirement savings? Isn't it weird that on one hand, the stock market did a record return, but on the other hand, the economy felt sluggish? I'm a certified financial planner. I've spent close to 10 years in the Canadian banking system, and it's important for us to understand the raw data behind these two Canadas. To understand this, we have to look at the math of 2025. On paper, Canada's GDP actually grew by 1.1 to 1.3% roughly. In a textbook, that actually looks like growth. It is growth, but here's the problem. The headline GDP that you see on the news does not tell you the full story anymore.
Canada's GDP fell 0.3% in October, which more than offset September's gain of 0.2%.
Between 2022 and 2024, Canada's population grew by over 3% per year. It's the fastest pace in all of G7. That growth primarily came through immigration. And here's the catch. When we have more people sharing a pie that's not growing as fast, everyone's slice gets smaller. This is what economists call a per capita recession. GDP can rise while living standards or individual incomes can still fall. By early 2026, our GDP per person remains lower than it was in 2019. We have effectively lost 6 years of individual prosperity. That's why economists, banks, and even the Bank of Canada are now focusing on GDP per person or GDP per capita, not the headline GDP I just mentioned. The biggest mistake in 2026 that Canadians make is thinking the TSX index is the Canadian economy. Well, they're not. They're very different. The TSX is dominated by 3 main sectors: banking, energy, and mining. And all of these roughly account for about 65% of the entire index. The stock market is not driven by Canadian consumers like you and me. Your TFSAs and RRSPs could be booming like I mentioned before, while your neighbor's restaurant is barely surviving. The big corporations who are listed on the Toronto Stock Exchange care about global oil prices, the price of gold, of course. We all know what gold did in 2025. The TSX is a global commodity at play, not a local consumer index. These companies earn most of their returns and revenue from outside Canada. Let's take a few examples. In 2024, oil averaged above 75 USD per barrel. Gold, like I mentioned, it went over $2,000. I wish we all bought some more of it. Anyway, Canadian banks posted a return on equity between 13 and 17%. The thing is, markets don't react today. They price in expectations. Historically, stock markets move about 6 to 9 months ahead of the economy. Now, the number that's the most shocking is that 99.8% of businesses in Canada are small and medium enterprises. They employ over 60% of the private workforce. Now, guess what? None of these 99.8% of businesses are listed on the Toronto Stock Exchange index. When interest rates were high at about 5%, these businesses were struggling under the debt. But because they're not listed on the stock exchange, their pain was never felt on your finance app. In the short term, the asset owners, the ones who owned all the assets that I just mentioned, were winners. It's the wage-dependent households who felt all the pressure. In the long term, the risk is building. Canada's household debt sits near 181% of disposable income. It's one of the highest in all of OECD countries. But here's the important part. Losers and losses are never permanent. Households that focused on reducing high interest rate debt, diversifying beyond Canada, and most importantly, staying invested instead of reacting emotionally, historically always recover faster when growth returns. The funny thing is, everyone knows this, but only a few follow. So let's bring all of this together. Point number 1, Canada is technically not in a recession. However, the per capita GDP, or the standard of living I mentioned, has been going down over the last few years. Point number 2. Now, this is the most important point of the video. Point is to understand the Canadian economy and the Canadian stock index are completely different from each other. The Canadian economy is what we see and experience every day in our daily lives. Things are getting more expensive. GDP is not growing as fast. The struggle is getting real. However, the stock index is telling us a completely different story altogether. To put this into perspective, the Canadian stock market outperformed the American stock market in 2025. It is extremely important for us to realize that we do live in two Canadas. One is what we see with our own eyes, and the second is what is shown to us on our cell phones, on our finance applications. Markets move on expectations, not emotions. It is very important to understand this gap, because understanding this gap will give you an advantage, not a reason to panic. My goal is not to create fear. My goal is to create clarity. Canada's economic challenges are real in 2026, but informed Canadians like you still have control through planning, diversification, and discipline. The last thing I want you to do is to look at the news, look at the headlines, look at the noise, and make your financial future pay for it. I have seen this so many times where decisions are taken only to realize that the two things are completely different from each other. Stay logical, stay invested, and most importantly, stay informed. Thank you for watching. I will be back with more finance content.